Well, we're already seeing it, aren't we? I think the technology sector has got some challenges from this point onwards. In stock market terms, nobody's debating whether these are amazing businesses or not. It really comes down much more to the stock market phenomenon of the valuation. And when we look at it through our four lenses, which is growth, valuation, momentum, and sentiment. Well, growth, tech's challenged both in absolute and relative terms going over the next 6 months. In absolute terms, because of the base effects, they're comparing themselves to where they were last year, when a lot of them got actually quite a boost from the economy going into lockdown. So that absolute comparison is going to become harder. Relative as well, because other sectors in the market are benefiting from lockdown easing in a way that they won't. So I think growth they've got growth issues over the next 6 to 12 months, both in absolute and relative terms. Valuations are high. Don't think there's any real debate about that. Interest rates are a key input into how you value these stocks. Interest rates have been going up. Therefore, the valuations are under pressure. Sentiment is still bullish generally. We're seeing the dip buying coming in quite repeatedly. We see it in surveys, professional investors saying that they think it's an expensive sector, but it's also shown to be the most widely held. So we know a lot of people are fully invested already. And last but not least, momentum. Well, momentum has turned. It has clearly turned. And there's no... the next key support level for Nasdaq is about 5 to 10% below here. And then we'll start to see whether this is just a cyclical kind of mini bear market within that sustained bull trend, or whether there's an inflection point. But I don't think there's much to stop us getting to that level, 5 to 10% lower. And then we'll start to get some interesting information about the trend.
Super interesting what you're saying there, because if you look at the price action the last couple of weeks, the main areas of retracement that we have seen are the areas that have been associated with frothiness in the market. So it's been, ARK Innovation Fund, Tesla, some of the cryptocurrencies, SPACs, all these segments that we've been talking about a lot as having extreme valuations. Do you think that this re-rating can continue, whereby some of the extremely valued areas of the market can reprice lower, but at a broad level, the index can continue to rise?
That is the million-dollar question. It's good to see that, by and large, that is exactly what's happened. I mean, this has been on the radar, I think, for 6 to 9 months. When were we going to see this rotation from growth potentially into value? And then there's obviously the COVID overlay on that. We call it growth and value. You could also call it, COVID winners, leaders, or COVID laggards. And we've seen the market go through a number of mini rotational cycles over that period. But this one does seem to have real heft behind it. And if you look at value and the value trackers, they do now look to have convincingly broken out. And the other thing which makes me think that this has longer legs this time is the interest rate environment. So the fact that the structure of interest rates is beginning to shift is showing that people are becoming, for the first time in the last, I was going to say 12 months, but you could actually say the last 3 years, people are beginning to buy into the notion of global growth, broad-based global growth again. And that's what's driving real yields higher. So that will continue to put pressure on the valuation of very growth, highly valued stocks in the so-called growth sector. And I think it will continue to support this movement in the value segments.